stocks sell at silly prices. It doesn't take a high IQ to figure out that they're cheap, but it does take a temperament that's willing to step up and actually act.
The recession is coming. That's what we're hearing in the news now. And it can be daunting if you don't know how to handle your finances, especially if you've never been through a recession before, or if you feel like you're not smart enough or experienced enough to manage your finances yourself. That's why we're going to listen to a man who has lived through countless recessions and has come out the other side richer, time and time again. Warren Buffett believes that extremely high levels of intelligence will not get you far in the stock market, or at least that's not necessary. Even joking that if you have a 160-point IQ, you should probably sell 30 points because you won't need them. Let's take a look at the full clip.
Most stocks at one time or another sell at very silly prices. And it doesn't take a high IQ to figure out that they're cheap, but it does take a temperament that's willing to step up and actually act. I tell people, if they're going in the investment business, if you got 160 IQ, sell 30 points to somebody else because you won't need it. I mean,
So, golden rule number 1 is that doing well in the stock market requires the right temperament rather than high intelligence. The message he's giving here is that it's easy for anyone to tell when prices are low in the stock market. We have charts which update minute by minute during trading hours. Anybody can see when prices come down. But the difficult part about making money in the market is temperament. You need to be able to buy when prices are low and hold on for the long term as the price increases. But most people are too emotionally affected by the price, allowing their fear to control their actions. Warren Buffett says these people are not cut out to own stocks. Do you want to know what the best investor of all time thinks about price? Let's take a look.
Where we've come?
well, anytime stocks go down, as far as I'm concerned, I like it because I'm a net buyer of stocks. I've been buying stocks ever since I was 11 years old. So when stocks go down, it's good news. Just like when hamburgers go down, it's good news, or Coca-Cola goes down, it's good news in terms of anything I buy. But
rule number 2 is that dips in the market are a good thing for investors. That's right, Warren Buffett sees stock market dips as an opportunity to buy the same assets at a lower price. He believes as a long-term investor, you should be happy when prices fall, as it allows you to buy more of the stocks you believe in. If you're so affected by temporary dips, it suggests that you don't believe in the company you're buying, which should never be the case. Let's take a quick look at this Investopedia article. Buffett was asked about what actually makes a good investment. He said it's important to focus on the quality of the business rather than on short-term price predictions of the stock or of the market, and to always look for quality businesses with a durable competitive advantage. So, the third golden rule when it comes to recession investing is to invest in companies which have strong, durable competitive advantages. These advantages are sometimes referred to as moats. It's something which sets a company apart from its competition on a long-term basis, something which can't be easily replicated or achieved by other businesses in the same industry, something which allows the company to preserve its market share long into the future. Let's take Google and YouTube as an example. On top of having first mover advantage, their algorithms are seriously impressive, and this is what sets them apart from the competition. On top of this, they've built a sort of brand around themselves, creating a reputation which is really hard for others to replicate. Other companies simply don't have the marketing budget to try and reach the same brand level as Google and YouTube. These are the kind of companies it can be good to invest in during a recession, because their advantages mean that they'll stick around long into the future, while other companies crash and burn.
Let's talk a little bit about the fact that the market's down almost 800 points this morning.
Yeah.
Concern for you?
Well, no, that's good for us, actually. We're a net buyer of stocks over time. And just like being a net buyer of food, I expect to buy food the rest of my life, and I hope that food goes down in price tomorrow. So when stocks are down, we're going to be buying on balance. And
who wouldn't rather buy it, at a lower price at a higher price? People are really strange on that. I mean, because most people, most of your listeners are savers, and that means they'll be net buyers, and they should want the stock market to go down. They should want to buy at a lower price, but they have that feeling that they just feel better when stocks are going up.
Rule number 4 is quite simple. Be a net buyer of stocks. You simply won't be able to accumulate wealth in the stock market if you aren't actually buying stocks consistently over a long period of time. Of course, for the average investor, there will come a point when you need to sell. This is likely when you retire, or if you want to leave money behind for your family in your will. But until then, being a net buyer is the way to build this wealth, rather than staying on the sidelines worrying about the economy and trying to time the market. Trying to time the market leaves you way too emotionally invested and exposed to risk, and you will end up beating yourself over time rather than the market. Remember, time in the market beats timing the market.
Well, I would say that at any given point in history, including when stocks were their cheapest, you could find an equally impressive number of negative factors. I mean, you could have sat down in 1974 when stocks were screaming bargains, written down all kinds of things that would have caused you to say, the future is just going to be terrible. And similarly, at any time you can write down a large list of things that would be quite on the bullish side. We really don't pay any attention to that sort of thing. I mean, we have, you might say that our underlying premise, and I think it's a pretty sound underlying premise, is that this country will do very well. The Dow went from 66 to 10,000 plus in the 100 years of the 20th century, and we had 2 world wars and nuclear bombs and flu epidemics and you name it, Cold War. There's always problems in the future. There are always opportunities in the future, and in this country the opportunities have won out over the problems over time, and I think they will continue to do so absent the weapons of mass destruction.
Golden rule number 5 for investing in a recession is that opportunities beat problems over time. This is a really important message which has been shown time and time again in the stock market. The amount of crashes, dips and cases of bad economic news over the last 100 years is too many to count. On any of the worst days, people would think that you're crazy for continuing to invest in the stock market. But if you had continued to invest, you'd be sitting on enormous profits because the good news and the good businesses tend to prevail over time. At any time, there are 100 reasons you could think of not to invest in the stock market. But again, sitting on the sidelines thinking about all the bad news is not going to make you money in the long run. At some point, if you want to make money in the market, you do actually need to buy in. There is no perfect time to buy. You can't predict the future. So Warren Buffett's method is to consistently buy over time, making sure your money is always working for you, while not paying attention to the daily price movements. He believes that trying to predict or beat the market will always be the downfall of the average investor. Remember, it's better to buy good companies at a bad time than to buy bad companies at a good time. Finally, here are a couple of bonus quotes from Warren Buffett about investing during a recession. First of all, he says nothing is permanent, there is light at the end of the tunnel. This is a crucial outlook to have during a recession. If you constantly focus on all the bad news, you'll drive yourself crazy, and you'll always be too scared to actually invest, meaning that you won't seize the opportunity to make money coming out the other side. He also tells people, invest in yourself. This is the most cliché advice of all, but it is still good advice no matter how many times we hear it. Warren Buffett suggests learning recession-proof skills and investing in your own knowledge and abilities to improve your earning potential. If you can increase your earnings, this can balance out any tough periods in the market where your investments aren't performing well. It can also be a good time to invest in your own business. At a time when competition is low and people are scared to start up their own businesses and don't have the money to plow into marketing and advertising, this can be your opportunity to seize market share by doing exactly those things. It might not pay off in the short term, but if you can establish market share during an economic downturn, you could have a booming business coming out the other side, creating the foundation of a competitive moat which we talked about earlier. One way to invest in yourself during a recession is to take advantage of all the free information available online and improve your own financial knowledge and understanding. If you enjoyed this video, please subscribe where we give free personal finance content and education on a weekly basis. Thanks for watching.